Chipotle's rapid deterioration from beloved weekly staple to overpriced slop bowl is one of the strangest corporate stories of the modern age. Just a decade ago, the chain was a cornerstone of the 21st century American diet, known for generous portions, fresh ingredients, lightning fast service, and stores packed with enthusiastic staff and loyal customers. If you needed a quick, healthy, affordable meal that could last for days between school, work, or home, Chipotle had your back. It was a company that genuinely seemed to take pride in not just what it served, but also who it hired and the impact it had on the world around it. Today, Chipotle is the opposite, with undermanned stores filled with overworked employees under pressure to give you the smallest portion possible off a stale, tired menu. But it's not because some executive randomly decided to start serving less food. Instead, what we're seeing today is the culmination of a 10-year-long pump and dump by a single Wall Street hedge fund, a play that netted them $3 billion and left everyone else with tiny portions and worse food. The rise and fall of Chipotle is a timeless case study about politics, power, strategy, and the fundamental trade-offs between founder idealism versus investor pragmatism. In this modern MBA episode, we dive into the economics and transformation of Chipotle through the decades and how a Wall Street hedge fund single-handedly fueled and crushed this once beloved Mexican chain. Chipotle and the entire fast casual market as we know today was created by McDonald's, Wall Street, and the legacy fast food industry. In the late 1990s, burgers had become saturated. Revenue had plateaued as there was a Wendy's, McDonald's, or Burger King on every profitable corner in the US. Americans literally could not eat any more burgers. Unable to simply open stores to grow, these titans were under pressure to show upside. At the same time, a new rival had emerged, delivering unprecedented growth and excitement. Yum! Brands was on the ascent with a multi-brand portfolio. As the owner of Taco Bell, Pizza Hut, and KFC, they scaled multiple categories simultaneously to own all three meals of the day. If parents wanted pizza and kids wanted tacos, Yum! Brands captured the entire sale. It was a similar dynamic abroad. In the late 80s, China opened its doors to the West and became the single most valuable growth market for American fast food overnight. Yum! Brands didn't just beat McDonald's to China, they dominated them. Fried chicken was an easier sell for Chinese consumers, and the company outmaneuvered the Golden Arches in localization and operations. Meanwhile, the novelty of Taco Bell and Pizza Hut captivated Americans back home. While McDonald's remained the stronger business, Yum! Brands held greater momentum and potential. The only way to grow in this emerging global fast food war was for McDonald's to assemble its own portfolio of brands and cuisines. By 2001, McDonald's had acquired Boston Market to fight KFC, bought a Midwest pizza chain to fight Pizza Hut, and invested in a tiny Denver Mexican chain called Chipotle to fight Taco Bell. Each move was aimed at chipping away at Yum! Brands' dominance across Mexican, pizza, and chicken. Yet it was Mexican that held the greatest potential. Since the 70s, Taco Bell had introduced and normalized Mexican cuisine, turning tacos, burritos, and quesadillas into mainstream staples. They had proven demand and unit economics over decades. Yet for all its success, Taco Bell remained anchored to teens, college students, and single males. At the same time, the broader cultural shift towards fitness and nutrition educated Americans to prioritize ingredient quality as much as portion control. By the 90s, the business case for a higher status, higher quality Mexican chain was clear. Taco Bell had made fortunes profitably selling $1 bean burritos and 60-cent tacos at scale. The same model, upgraded with better ingredients, could command 3 times the price and twice the profit. Startups like Baja Fresh and Chipotle emerged to fill this gap, replacing beef crumbles and processed cheese with real steak, fresh salsa, and steamed rice. Ultimately, Mexican cuisine was more than just a trend. By the mid-2000s, McDonald's was under fire from Western media and regulators for their role in the obesity epidemic. The unprecedented scrutiny upended the fast food burger business, reshaping its existence from an essential tradition and into a public health liability like cigarettes. All this further elevated Mexican cuisine as the superior, fresher, healthier mass-market alternative and the next big frontier for fast food. McDonald's sunk hundreds of millions of dollars into Chipotle after its initial investment, not just to hold a stake in this fast-growing category, but also to hedge against the increasingly fragile burger business. Their backing of Chipotle set off an arms race as rivals raced to acquire Mexican chains and assemble multi-brand portfolios of their own. Wendy's shelled out over $250 million for Baja Fresh. In 2002, it was the #1 Mexican fast casual chain with more stores than Chipotle. With no freezers and microwaves, they boasted a comprehensive, customizable menu that included fajitas, enchiladas, and shrimp. But this West Coast chain was not as scalable or bulletproof as advertised. Despite its fast casual branding, Baja Fresh was really a conventional sit-down restaurant where food was cooked to order. With high complexity and intensive labor, Baja Fresh was too inefficient to capture the throughput of a Chipotle, too cheap to capture the margins needed to offset its cost structure, and too expensive to drive the habitual volume of a Taco Bell. To make matters worse, Wendy's forced new Baja Fresh stores into legacy drive-thru properties and refused to invest further, believing the concept to be mature enough to sell itself. Meanwhile, McDonald's poured capital to nurture Chipotle and secure the prime locations needed to reinforce its premium positioning. Starved and neglected, Baja Fresh crashed. After just 4 years, Wendy's dumped the chain in a fire sale for $30 million, a tenth of what it had initially paid. Meanwhile, Jack in the Box found its horse in Qdoba. Compared to Baja Fresh, it was a far better business. Qdoba was a copycat. Its Denver-based founders had witnessed the early success of the first Chipotle in 1993 and replicated its core blueprint, from the open kitchen to the customer-facing assembly line. The first Qdoba opened up just miles away from the original Chipotle. They traded quality for variety and forced differentiation by offering the very items that Chipotle refused to, like queso, nachos, and soup. It was enough for the fast-growing brand to be worth $45 million in the eyes of Jack in the Box, who leaned hard on franchising to drive expansion. But unlike McDonald's, the company lacked the leverage and relationships for prime real estate. As a result, Qdoba often ended up in lower-tier strip malls, suburbs, and urban sites. The franchisee model also made consistency impossible, as customer experience varied store to store. Fundamentally, Qdoba and Jack in the Box were simply too small. They couldn't match the resources or talent of McDonald's and Chipotle. As an inferior copycat, Qdoba remained a distant number 2 rather than a true competitor, even with the promise of free guacamole. Jack in the Box eventually sold the Mexican chain for $300 million in 2017, having nonetheless played a pivotal role in shaping the modern fast casual burrito market. Chipotle's success through the 2000s was not a case of simply having more money than everyone else. While Jack in the Box and Wendy's acted like landlords, maximizing returns from their acquisitions, McDonald's acted more like a silent partner. Even though they funded Chipotle's expansion and kept the chain afloat through losses, the Golden Arches allowed Steve Ells, Chipotle's uncompromising founder, to steer the ship. Yet the relationship between founder and investor was contentious. McDonald's pressured Chipotle to follow the fast food playbook, add drive-thrus to increase volume, introduce fries to boost spend, redesign stores with bright plastic and family seating, and downgrade to the cheapest cuts of meat. As a chef, Steve fought McDonald's at every step. He was repulsed by frozen factory slop and refused to franchise. Chipotle's ruthlessly small menu was driven more by personal conviction than hard math. It was the only way he believed high-quality ingredients could be delivered quickly, affordably, and at scale. While its rivals sacrificed efficiency and quality in exchange for variety, Chipotle's streamlined model enabled them to uniquely serve hundreds per hour. This unprecedented combo of speed, quality, consistency, and value became Chipotle's defining advantage. But even as Chipotle thrived through the mid-2000s, it was a tiny speck in McDonald's empire. For every $100 that the Golden Arches grossed, only $3 came from burritos. And for all the backlash over nutrition, McDonald's financials remained stable, with the stock on a clear path to recovery. But in the view of Bill Ackman, one of Wall Street's present-day legends, McDonald's stock had every reason to be higher. In time, he would play both the hero and villain for Chipotle as the force who enabled its rise, only to later wring out every bit of value for personal gain. But for now, Ackman would be the hero. He had been Wall Street's golden boy, a wonder kid who made his name during the 90s hedge fund boom, shorting companies. He would tank their stocks by releasing 100-page research reports and waging public crusades against management in the press. But in 2003, his luck would run out as his hedge fund collapsed. By 2005, Ackman had re-emerged with a new fund, Pershing Square. Seeking redemption, he set his sights on McDonald's. In the mid-2000s, McDonald's was trading at around $30. Ackman borrowed billions and bet it all that the share price would increase 50% within 2 years. Since his position was built on options, he needed the stock to go up fast and high enough to turn a profit. If McDonald's stock failed to surpass $40 by year 2, Pershing and Ackman would both be wiped out. With the clock ticking, Ackman had to force a positive market reaction fast. He went public with a 100-page presentation asserting that the company was leaving billions on the table and that shareholders deserved more. He demanded that McDonald's spin off its real estate into a separate entity, borrow billions to fund share buybacks, and divest non-core brands like Chipotle and Boston Market to refocus exclusively on burgers. Despite their contentious relationship with Steve, McDonald's saw Chipotle as their high-growth asset of the future, but Ackman saw differently. He argued that the Mexican chain was being held back. Chipotle would be far more successful and command a far higher valuation as a standalone, independent business through its own IPO. McDonald's in turn could liquidate its stake and return those proceeds to shareholders. It was all just financial engineering, but Ackman's math was compelling enough to rally other shareholders. He started assembling a coalition of investors and spreading awareness through the press. McDonald's couldn't ignore his demands without risking a proxy war. While they rejected his proposal on real estate, the Golden Arches quickly conceded on the rest to appease shareholders and to sweep the story out of the news cycle. They agreed to refranchise 1,000 stores to lean further into real estate, increase share buybacks to $6 billion, and to spin off the non-burger brands. Chipotle's IPO turned McDonald's $350 million investment into a $1.1 billion windfall. These measures fueled a massive bull run, doubling McDonald's share price to over $60 by 2007. McDonald's exited the fast casual market, Steve regained full control of the company he founded, and Ackman closed out his position to walk away with $500 million in profit. Now independent, Chipotle returned to its founder-led model. From 2006 to 2010, Steve worked to shed McDonald's past influence and ingrain the unorthodox philosophy that had made the chain successful in the first place. Steve adopted an unconventional co-CEO structure where he focused on supply chain and product while his childhood friend Monty Moran took charge of staffing and operations. Like before, he dismissed the constant shareholder calls for standard restaurant industry tactics like limited-time offers, promotions, and menu expansion. Instead, he and Monty refined the core system, equipment, and worker roles to push throughput. Tortillas were now warmed in seconds, dedicated expediters handled bagging, cashiers focused on payment, and a single cook in the back restocked so that the assembly line never stopped moving. Yet Steve and Monty were also mindful of workers as humans. They treated Chipotle as a vehicle for change. The company introduced unprecedented six-figure compensation packages for top-performing managers, cut ties with industrial farms to reduce pollution, removed GMOs from its supply chain, championed mentorship over micromanagement, and required a minimum % of ingredients to be sourced from small farms to lower its carbon footprint. While the chain had expanded aggressively under McDonald's, Steve hit the brakes, asserting that talent, not capital, was the real constraint. Chipotle would now only open as many stores as it had good people to run them. Managers were evaluated less on profit and more on leadership, team cohesion, and employee morale. Stores with lower revenue but stronger staff camaraderie, higher energy, and better retention were favored over those with better sales and stressed environments. Workers were promoted based on their soft skills as much as performance. It was a simple belief of inputs and outputs. Happy employees produce faster lines, better food, and loyal customers. Even as spending slowed during the Great Recession, Chipotle reached new heights. With industry-leading restaurant-level margins, the company demonstrated that the costs of premium ingredients, intensive labor, generous portions, and direct ownership over every store could be offset by radical efficiency, sheer volume, and genuine customer loyalty. From 2010 to 2014, Chipotle would enter its golden age. The stock in this period soared from $200 to $800, outperforming the S&P 500 by 4 times. Their valuation multiples exceeded even their former parent, McDonald's, at its historical peaks. On a per-store basis, the average Chipotle was grossing more than most of the fast food brands and netting higher margins than steakhouses. Investors saw Chipotle not as a fast-growing restaurant chain, but as a disruptive, blue-chip consumer tech business on par with Netflix and Amazon. Under Steve, the company had spent virtually nothing on mass advertising and was only at a fraction of the scale of Taco Bell. The majority of restaurants were concentrated in just 10 states, with no presence in the Deep South, Great Plains, and overseas. Chipotle looked poised to disrupt not just fast food, but the entire restaurant industry. With results like these, few could question Steve. He was revered for seeing a future 2 decades ahead of anyone else and sticking to it when no one believed. He continued to double down on values over convention, removing carnitas rather than compromise on animal welfare, refusing trends like ordering kiosks and table tablets, underpricing the menu to maintain accessibility nationwide, and vetoing annual price hikes, insisting that prices should only rise when justified by better ingredients. Brown rice, chips, and sofritas became new core additions. Stores got new grills that could cook multiple items simultaneously for better sear and faster output. Chipotle was among the first restaurants to launch a mobile app as a way to relieve the in-store lines. Steve wasn't resistant to change. Rather, he simply filtered every possibility under a single lens. It had to improve either throughput or quality. Chipotle's success ignited a fast casual gold rush as investors and operators rushed to replicate this seemingly perfect business model. Blaze applied the format to pizza and was quickly followed by a wave of clones like Mod, Pieology, and Pizza Rev. Sweetgreen extended the model to salads and even higher price points. Meanwhile, Cava and Zoe's Kitchen replicated Chipotle for Mediterranean cuisine, positioning themselves as fresher, colorful, modern alternatives. All these new entrants were backed by venture capital, private equity, or the legacy fast food chains who were increasingly worried about being left behind. The surge of Shake Shack, along with failed healthy pivots by legacy fast food giants through the mid-2010s, demonstrated that Americans were willing to pay more for higher quality fast casual food, and to do so through new brands. The rapid emergence of new entrants meant that Chipotle was now simply the new baseline. Because all these concepts targeted the same demographic of urban professionals and millennials, they were all competing for the same real estate. Before, Chipotle only needed to outbid Subway, Starbucks, or Panera Bread. Now, it was facing dozens of these cross-category imitators for the same space. For Steve, Chipotle was not about Mexican food, but instead a repeatable formula of real estate, operations, supply chain, and culture that could be applied to any cuisine. While they couldn't compete everywhere, they also couldn't afford to let these startups sweep the market entirely. Steve went on the offensive with ShopHouse as a first mover in Asian cuisine, a category long defined by fried foods, frozen ingredients, and heavy sugary sauces. On defense, he launched Pizzeria Locale, aiming to replicate wood-fired pies at a fraction of the time and cost. These new ventures reinforced Chipotle's narrative to investors that they were a platform company rather than a Mexican chain. Now, a decade later, most of this fast casual boom turned out to be a false gold rush. What was once hailed as long-term disruption ultimately proved to be short-term hype. Today, Blaze has shifted to franchising to survive, Mod is shuttering nationwide, Pieology is bankrupt, and Pizza Rev has vanished, while the old-school giants of Domino's, Pizza Hut, and Papa John's continue to thrive. Sweetgreen has never been profitable at any point in its 19-year history and continues to lose hundreds of millions of dollars every year. The demand for $20 salad bowls evaporated with the rise of remote work, inflation, and economic slowdown. Zoe's Kitchen crashed under plummeting sales, and its real estate was harvested by its closest rival. Cava remains the lone survivor, but even they have only sustained through constant menu innovation, suburban expansion, and minimal price hikes. The Chipotle operating model would prove to be far from the silver bullet that Steve and many others dreamed of at the time. Yet none of this was visible in the context of 2011 to 2015. During this golden age, Chipotle was the market maker, the model everyone copied, and the stock everyone wanted to own. Their breakout drew the attention of a bitter Bill Ackman, now 8 years removed from Chipotle's initial spin-off. He had exited McDonald's far too early, selling all his shares just before the Golden Arches entered a multi-year rally that ultimately tripled the stock. Ackman had left literal billions on the table. He had instead redirected the profits from McDonald's to fund an activist turnaround at Burger King. But what was supposed to be a simple deal turned into a grueling fight, bogged down with private equity, cost-cutting, messy franchisee battles, and expensive marketing. Pershing Square exited Burger King with over $1 billion in profit, but in hindsight, riding Chipotle's ascent would have been easier, faster, and more lucrative. Yet Pershing Square was not a mutual fund that could simply ride the market like a passenger. As a hedge fund, it needed to generate alpha to justify its fees. Ackman needed a reason to invest in Chipotle, some credible case that the company was mismanaged, underperforming, or inefficient, something that could justify Pershing's position and activism. But there was no such argument. Investors were ecstatic with their 3,000% returns. If anything, Chipotle was overvalued, not undervalued. It had become one of America's most admired companies, and Steve was idolized as a culinary prophet. Beyond the pace of expansion, there was no real operational weakness, no material shareholder dissatisfaction, and thus, no cause for intervention. Yet just 1 year later, a black swan event would strike, creating the generational opening for Ackman to not only pounce, but also alter the structure and direction of Chipotle forever. We've covered a wide range of topics on modern MBA, from nightclubs and barbershops to cookies and bubble tea. We manually parse financials, focusing not just on revenue and profit, but on the key metrics that reveal how each industry and business actually performs. This rigor is why modern MBA videos are used in university classrooms, from UC Davis to Denver. Because data integrity and original insight are core to what we do, we've always been skeptical of AI. Every AI tool hallucinates numbers, quotes incorrect headlines from questionable sources, and blindly confirms whatever you want to believe. Over the years, we've built an internal database, a vault of curated financials and verified operating metrics across dozens of industries. But even though we have the most reliable data, it's been impossible to actually use it all together. If we want to analyze across industries, we have to navigate thousands of cells, stitch formulas across hundreds of tabs, and then manually reconcile the findings with the latest earnings. It's tens of hours for a single query, which is why we've never attempted it in the first place. If we upload these sheets to Claude, it would be the same problem. We'd have to download, upload, explain, wait, and then repeat this all over again whenever we collect new data. For years, we couldn't find a way to integrate AI into our workflow to improve quality, until now with Zapier. With Zapier, cross-industry real-time analysis is finally achievable. We can ask questions of our own dataset in simple English like, is the restaurant or retail industry structurally more profitable than fashion? With Zapier feeding Claude, we can wield the full depth and breadth of our dataset to find just how nuanced this answer really is. What is the worst business ever covered on modern MBA? Is it oat milk, GoPro, BuzzFeed, esports, scooters, or something even worse? Hilariously, Claude is able to tell us automatically through Zapier that the worst business we've ever covered is none of these companies. Instead, it's Wish.com. My favorite, how many modern Pokemon cards and what exact kind and condition would you need to sell in a year just to gross as much as a single Taco Bell? Through Zapier, Claude securely accesses our internal vault, eliminating hallucinations and guesswork entirely. Zapier MCP integrates everything into a single workflow. Instead of manually prompting Claude every time, we just say run a full analysis and get answers grounded in our own trusted data. Yet where Zapier shines is that it automatically injects live context from recent news about the exact companies we've asked about. This means all findings get automatically pressure tested to see if these past business patterns are still holding or are starting to break. It's been awesome seeing Zapier unlock value that simply wasn't possible and better the quality of our work. Future analysts at Modern MBA can securely access our vault to collect findings without getting bogged down in raw spreadsheets. And our MCP is built with Google Sheets, Drive, and Web Search, as that's just what we use today. But if the team starts using Slack or Airtable, we can simply add those steps in, as Zapier supports over 9,000 apps. If you're tired of trying to squeeze value out of isolated AI tools and want to actually bend AI to fit into your existing workflows rather than the other way around, Zapier is that missing piece. Go to our special link in the description to get started with any one of Zapier's ready-to-go templates and get real plug-and-play results from AI. Thank you to Zapier for supporting Modern MBA and making this episode possible. Chipotle would enter its fourth and most transformative era in 2015. It started in Minnesota, where 64 people came down with salmonella after eating at Chipotle. A month later, more than 200 customers in Los Angeles contracted norovirus after a sick manager was allowed to work, resulting in one of the largest single restaurant outbreaks in American history. Yet the real hammer would drop just 2 months after, when 60 people came down with E. coli after eating at Chipotle's across 11 states. Then just weeks later after that, more than 100 people, including an entire college basketball team, came down with norovirus in Boston after another sick employee showed up to work. Steve made a public apology on the Today Show, but no one could stop the fallout. The persistence, frequency, and scale of these incidents was unprecedented. This was not just a PR disaster, but a genuine public health crisis that no company statement could sweep under the rug. The CDC, FDA, and Department of Justice quickly launched a criminal investigation into the company. By the end of the year, few dared to eat at Chipotle. In less than 6 months, Chipotle had suffered 5 separate outbreaks, sickening over 500 customers across 14 states and involving 3 completely different pathogens. It was a black swan event, unpredictable, massively consequential, and only explainable in hindsight. Even the deadliest food safety disasters in American history had been isolated to single events and single batches. They never cascaded like this. Sales and consumer trust evaporated almost overnight. The stock dropped over 35% in a single month and would continue to freefall to a 70% decline a year later, wiping out nearly all the gains of the golden age. The sheer improbability of the entire situation and the rapid reversal of fortunes triggered conspiracies amongst investors. Perhaps this was the result of sabotage from short sellers, GMO lobbyists, or even McDonald's. But in reality, there was a simpler explanation. In pursuit of local, sustainable, and ethical ingredients, Steve had decentralized Chipotle's supply chain during the Golden Age, shifting away from big conglomerates and towards small regional farms. These small farms didn't have the record-keeping rigor and traceability technology as the big industrial suppliers. As a result, neither Chipotle nor the CDC were able to ever determine exactly what ingredient caused all these outbreaks and which farm it came from. Steve's commitment to freshness was also at fault. Despite scaling to thousands of locations, all the produce was still being washed, chopped, and prepared by hand at each store. This meant that food safety rested on the daily discipline and execution of Chipotle's 60,000 hourly workers, and all it took was a single employee to slip up for bacteria to spread. With a crisis on their hands, Steve and Monty moved rapidly to re-industrialize the supply chain with new safety protocols. Barcode traceability was mandated on every shipment of meat and produce. Steak was no longer grilled from raw at every store, but instead pre-cooked in sous vide bags. Tomatoes and cilantro were now sanitized and diced in central kitchens before being shipped to every store, and every ingredient got tested for pathogens. The sudden collapse in demand also forced cost discipline downstream. With customers no longer automatically walking in the door, food safety and P&L became hard requirements for store managers. Good vibes and happy staff were no longer enough to get promoted. Meanwhile, nearly all the positive momentum was wiped out. The launch of chorizo as a new meat, the expansion of Shop House and Pizzeria Locale, and even the rollout of a rewards program were all overshadowed by the food safety crisis. Just as Chipotle was projecting this total commitment to rebuilding trust, the company's CMO was suddenly arrested in an NYPD drug bust. He had been caught on wiretaps arranging monthly cocaine deliveries to his apartment for nearly half a year. The optics were as ironic as they were disastrous. The executive had been friends with Steve and Monty since college. Even after his indictment, Steve refused to fire his longtime friend and even reinstated him less than 3 months after his arrest. Shareholders began to question Steve's judgment and his prioritization of friendships over business. The situation only added to the growing perception that Chipotle was an old boys club rather than a disciplined company. At the same time, despite tens of billions of lost market value, Steve and Monty each remained some of the highest paid CEOs in America. They were each paid the equivalent of a full CEO salary, with individual compensation packages that surpassed what Tim Cook, Jensen Huang, Howard Schultz, Reed Hastings, and other famous CEOs were making at the time. Despite splitting responsibilities between operations and food, they had each objectively failed in their assigned domains. But most damning of all was that neither leader offered a compelling plan on how they were going to restore growth. The company was now intentionally overstaffing every store and handing out millions of burritos for free to win back customers. This only spiked labor costs and wiped out the stellar margins that had fueled Chipotle's valuation in the first place. These moves all felt less like strategy and more like rash, emotional panic reactions. It didn't help that Steve declined to make any further media appearances after his apology on the Today Show. His reluctance to engage publicly forced the company to lean on cold, impersonal, and rehearsed press releases that did nothing to reassure customers. Disgruntled investors increasingly directed their anger at the board, which appeared to be another old boys club who were more interested in rubber stamping Steve's paychecks than holding him accountable. With the stock down by more than 50% and increasingly restless shareholders, Ackman pounced. Pershing sunk over $1 billion in Chipotle, acquiring 9.9% of the company. At this stage, Ackman was a living Wall Street legend who had left a trail of bodies wherever he went. Since his campaign against McDonald's in 2007, he had deposed 9 different CEOs and reshaped industries from railroad and pharma to fashion and bookstores. He and his hedge fund were coming off a catastrophic loss that had his own shareholders stunned and erased much of his earlier gains. Ackman was desperate for a win, and burritos looked simple in comparison. Chipotle immediately went on the defensive, hiring banks and lawyers to try and prevent Ackman from buying more shares. Publicly, Steve gave Pershing Square the cold shoulder. He saw Ackman as a corporate raider with the exact kind of short-term mentality he had spent the past decade fighting against. But it was all futile. Wall Street, like Silicon Valley, runs on soft power, and Ackman had no shortage of it. He didn't need to own 51% of Chipotle to take control. By 2016, more than 95% of Chipotle's shares were owned by institutions. If enough institutions aligned behind Ackman, they could collectively vote out the existing board and management, including Steve, and put in their own hand-picked leaders to run the company. All Ackman needed was to flip the biggest ones onto his side, Vanguard, BlackRock, and Fidelity, and convince them that he had a better plan to save the company than Steve and his college pals. These three index funds combined held roughly 30% of Chipotle. Behind the scenes, they had begun souring on Steve amid the stock's multi-billion-dollar collapse, looming criminal investigation, and ongoing embarrassment surrounding its CMO, who still somehow had a job. Below these giants sat hundreds of smaller institutional investors like endowments and pension funds, each holding less than 1% of Chipotle yet had far more to lose. For them, every dollar lost in Chipotle was a dollar less for their unions. These losses could not be swept under the rug the same way they could at index funds. Ackman became the spearhead for all these disgruntled institutions. They could quietly support him behind the scenes while he waged the public war that they could not pull off themselves. So while Steve and Monty had their hands full just trying to keep Chipotle from unraveling, Ackman was working full-time to build this coalition, holding private conversations, flipping shareholders to his side, and turning sentiment against management. If Chipotle was to go to war against Pershing, it would be a humiliating, drawn-out public affair, one that Ackman would win every time in a landslide. It would also be a distraction that the business could not afford. Thus, Chipotle had no choice but to settle. Ackman was granted 4 board seats that he then filled with his own people. The company accepted his demands to fire Monty and permanently abolish the co-CEO structure. In exchange, Ackman agreed not to publicly criticize Chipotle or launch a hostile takeover. With Pershing's enforcers now inside the boardroom, the company's priorities changed overnight. Ackman's vision was that Chipotle didn't need to invent new things, it simply needed to make the existing product easier to buy. While Steve believed seeing workers scoop food was part of the customer experience and that digital ordering would forever be a supplement to the in-store business, Ackman saw it as the complete opposite. For him, digital was the low-hanging fruit that would materially grow revenue and profits as the primary sales channel of the future. By pushing more customers onto the app, Chipotle could install a second assembly line inside every restaurant dedicated exclusively to fulfilling online orders. Instead of having to double the size of the store or staff, each location could now process twice as many orders simultaneously. At the same time, the digital line would remove the system's biggest bottleneck, which were the customers. Workers would no longer need to wait on people to make their selections or ask questions. This line would be inherently optimized for not just speed and efficiency, but also profit. For in-store customers watching every scoop of rice, cheese, meat, or guacamole, workers generally gave out larger portions to avoid confrontation and to keep the line moving. But on digital orders, there was no customer present to haggle over portions. Employees could now follow exact corporate serving specifications with far greater consistency. As a result, the exact same burrito ordered online would carry a lower food cost and net higher profit than one ordered in person. At scale, every fraction of protein removed from millions of bowls and burritos across thousands of stores would quietly flow straight back into Chipotle's margin. Thus, to Ackman, digital was low-hanging fruit that Steve had stubbornly and needlessly resisted for years. In his view, Steve was too ideological to be an effective CEO. He was wasting time and money chasing marginally better ingredients when the foundations of a far more profitable business were already sitting in front of him. Now with direct influence inside the company, Ackman's recommendations turned into mandates, and digital ordering quickly became the company's new obsession. The old emphasis on culture was replaced with hard, immediate financial targets, as Steve publicly committed to cutting $100 million in cost and hitting an earnings per share of $10. It was just one of Ackman's many signals from behind the scenes that Chipotle, under his watch, would now finally prioritize profits over ideology. By mid-2017, Chipotle appeared to be emerging from the crisis. Sales had slowly rebounded. The higher-margin digital channel surged as the company rolled out incentives for app sign-ups and mobile orders. Every store was now equipped with a secondary digital make line. For the first time in 3 years, the chain felt confident enough to raise prices. The maligned CMO returned to work, and Steve remained in the kitchen, developing new menu items like queso, margaritas, and tortilla desserts to re-excite customers. It had been 19 months since the last incident. No new outbreaks had occurred. His supply chain reforms and new management protocols seemed to be working. By every measurable metric, the turnaround was working. Investor confidence slowly returned as Ackman continued reshaping Chipotle into a disciplined, numbers-driven machine. Everything was going smoothly until July, when a norovirus outbreak at a single store in Virginia sickened over 100 customers. It was discovered that once again, a sick employee had been allowed to work despite Steve's new zero-tolerance policies. The incident immediately reignited the Chipotle is unsafe narrative, undoing much of the hard-earned trust the company had spent the past year rebuilding. Within hours, the stock collapsed. Investors were baffled at how this could keep happening while customers feared it as the start of another food safety crisis. Like any good activist, Ackman would not let this crisis go to waste. Steve had made progress, but not at the speed, urgency, and scale needed. He was also not an obedient, loyal executioner who was willing to fully embrace Ackman's digital, data, and profit-first model. The Virginia outbreak and ensuing stock sell-off had made the situation untenable for Pershing Square. Despite 18 months of intervention, Chipotle's shares were still trading below the hedge fund's entry point. Pershing Square was now in the red for a third consecutive year. For his own shareholders, Ackman needed results and fast. With the board now firmly under his control, he mobilized quickly behind the scenes for a regime change. In reality, the Virginia outbreak was very different from the 2015 crisis. It was an isolated incident caused by human error rather than the systemic supply chain failures of the past. And from a pathogen standpoint, norovirus outbreaks are relatively common and occur every year in the restaurant industry. Steve's food safety protocols had worked, and they still remain in effect to this day. Ackman weaponized the Virginia outbreak as an excuse to boot Steve out of his own company. He argued that Steve had been given 18 months, unlimited resources, boardroom support, and continuous executive help, yet people were still getting sick eating Chipotle. In short, Steve was framed as the problem, a founder who was too emotional, dogmatic, and stubborn to adapt and evolve with the company. Ackman did not personally wield the knife, but he certainly sharpened it. No one ever came to Steve's defense, and the board let all the criticism, panic, and controversy fall on his shoulders. It's likely that Ackman, with all his media connections, quietly amplified the Virginia incident in the news in order to justify the regime change behind closed doors. The reality was that Ackman had already found his guy. He just needed the opportunity and excuse to depose Steve. Less than 3 months after Steve's forced resignation, Brian Niccol was announced as Chipotle's new CEO. Leadership transitions at Fortune 500 companies generally span 6 to 12 months. In contrast, Chipotle's search was extraordinarily short, lasting just 76 days. Brian uniquely embodied the fast food rigor, digital expertise, and ruthless mentality that Ackman wanted for Chipotle. He was also extroverted, media-trained, and understood the value of visibility, publicity, and social media, things that Steve never embraced. Most important of all, he was a proven value extractor who would prioritize shareholders, hit the biggest numbers, and stay loyal to the man who appointed him. In Ackman's view, Taco Bell, under Brian, had achieved everything that Chipotle lacked. The discount chain had become a cultural engine, launching breakfast, pioneering mobile ordering, driving app engagement, and extracting maximum spend through engineered scarcity of beloved products. Brian, in short, was the perfect candidate. He set fire to the past immediately, moving Chipotle's headquarters to Southern California, even though the company under Steve had just signed a 15-year lease in downtown Denver. Employees who had been with Chipotle since the 90s were effectively purged, as most simply could not afford to suddenly uproot their lives or relocate to Orange County. The long-maligned CMO was finally fired. He also put a permanent end to the platform vision, shuttering Pizzeria Locale, Shop House, and Tasty Made, Steve's latest burger concept, for dragging down the bottom line. In his first appearance, Brian promised $10 billion in annual revenue, more than double existing sales, 5,000 stores nationwide, nearly twice the company's current footprint, and an additional $1 million in average unit volume. His agenda was clear. He was there to slash, burn, and squeeze every last bit of growth and profit as quickly as possible, even if it meant accelerating the company towards saturation and commoditization. Initially, Brian was eager to bring over elements from Taco Bell. He teased upcoming innovations like nachos, Mexican chocolate milkshakes, and avocado tostadas as modern takes on a legacy menu. Yet all of these items were quietly abandoned as quickly as they appeared. Ackman had chosen Brian to optimize, not reinvent, the business. These new items would only slow the line, lower sales, and reduce margin. Even nachos, which tested well, were scrapped simply because they cannibalized sales from the higher-margin burrito bowls. Brian quickly fell in line with Ackman's mandate. Nothing should ever interfere with throughput or the economics of the core business. This is why Chipotle moved so quickly to restrict the viral quesadilla as a digital-only offering, rather than fully integrate it into the menu. While this was publicly framed for convenience, it was in reality designed to push more customers onto the app, shift more sales towards higher-margin digital orders, and protect the main assembly line. In lieu of menu innovation, Chipotle under Brian simply rearranged existing ingredients into new products like keto and paleo bowls. Limited-time proteins such as carne asada and brisket served a similar purpose. While marketed as exciting new additions, they all function primarily as promotional vehicles designed to increase check sizes, manufacture artificial scarcity, and spike sales whenever they rotate onto the menu. Since every new item is an upcharge, the company's profit margins remain insulated. For what Chipotle saved in R&D, they blew on marketing. They poured money into advertising and publicity stunts that would have been unimaginable under Steve, sponsoring esports teams, embedding in video game tournaments, paying streamers to eat on camera, and pushing gimmicky merchandise, all just to keep the chain constantly top of mind for millennials. By 2020, Brian's innovations were purely operational. Pickup shelves were installed inside every location so mobile customers could grab their orders without interrupting the in-store assembly line. Cost consultants were hired to analyze how much prices could be raised in every neighborhood without losing sales or triggering headlines. While Steve had historically only raised prices when necessary, Chipotle now runs on continuous, semi-annual, and tiny price increases store by store and item by zip code. The company also clamped down on serving sizes for the first time ever. Managers are now evaluated not only on P&L and food safety, but also on portion control. Every night, a system at HQ automatically calculates how much food a location should have used based on sales and compares it against how much inventory actually disappeared. Any store found giving away too much chicken, steak, cheese, or guacamole gets flagged and audited. This, in turn, has led to the present-day dynamic in which managers scrutinize workers with food scales and discipline those who overportion in order to protect their own bonuses, and those same workers underportion customers to keep their jobs. By 2020, Brian had delivered the ruthless optimization that Ackman wanted, with digital orders making up nearly $3 billion in sales for the first time in company history. Chipotle's stock surged to all-time highs, driven by the landmark results and management aggression. Nothing was off limits for Brian. He raised the store target from 5,000 to 6,000, incorporated drive-thrus to new locations, and pursued expansion across Middle America in towns as small as 40,000 people under the sole pursuit of growth. Ackman's stake had more than tripled in under 2 years. By 2023, Brian was habitually raising the goalposts with little regard for the long-term health of the company. He promised 25% profit margins and achieved it through 15% price hikes and even stricter portion control. He proclaimed that the average store would soon gross $4 million a year off the exact same tactics. In his own words, the next Chipotle was Chipotle itself, and that the business could compound growth through scale alone. Shareholders lapped up his story as Brian continued to serve them above all. He talked up dystopian innovations like the implementation of cameras and AI as automated surveillance systems to flag overportioning, along with replacement robot dispensers programmed to dump the correct serving size every time. For customers, his only major announcement was renaming barbacoa as braised beef barbacoa. Ultimately, Chipotle would never sustain the trajectory that Brian had promised, as most of the growth was engineered. Yet Brian and Ackman would both eventually leave the company just as customers began pushing back against the nickel and diming that had become institutionalized over the past 6 years. They never planned to stick around long enough to bear the consequences of their decisions. Brian's initial response to the portion controversy only enraged customers, and the unexpected scale and intensity of their blowback signaled to him it was time to jump ship. He repeatedly dismissed claims that portion sizes had changed, insisting it was unnecessary to videotape workers and recommending that customers give employees a simple nod or a look if they wanted more food. But by mid-2024, the social media criticism had evolved into a material sales slump as Chipotle posted the first negative same-store sales in a decade. Rather than adjust the policies that had created this problem, Brian settled for a band-aid. He budgeted an additional $100 million in food costs and sacrificed half a point of profit to temporarily increase portion sizes for all. But in reality, Brian was already 1 foot out the door. As CEO, he saw the numbers before anyone else and knew he had squeezed the lemon dry. Chipotle, under his watch, was becoming increasingly oversaturated, overpriced, and stale. Every store was operating at record speed. The menu and ingredients had all been streamlined down to the cheapest and most efficient variant. While Steve had worn high food costs as a badge of honor and proof of ingredient quality, Brian had hammered down food costs down to a record low of 29%, a reduction only possible at scale with aggressive price hikes, portion control, and lower quality ingredients. Digital ordering had matured at 35% of sales. The limited time proteins had become predictable rotations. And there were now too many stores, as every new location was starting to cannibalize sales from existing ones. The only growth lever Brian hadn't tried was true menu innovation, yet that was now fundamentally incompatible with the company he had built. The talent, muscle, and creativity needed to achieve that kind of innovation had all been eradicated under Ackman's earlier purges. If Brian was to sustain Chipotle's valuation, he would have to pursue much harder and riskier opportunities like international expansion and labor automation, initiatives that would require significant capital expenditures and years of investment. In short, there was nothing left to optimize in the short term and nowhere for the stock to go but down. Ackman also saw the writing on the wall. The hypergrowth he had architected had reached its natural conclusion. He made no effort to persuade Brian to stay, nor did he care about Chipotle's next chapter. With the easy money gone and margins squeezed to the point of customer resentment, his hedge fund had extracted all the value that Chipotle had to offer. By the time of Brian's resignation, Ackman had already sold off 85% of his position. Of those shares, 22% were sold at all-time highs just weeks before Chipotle's stock started tumbling down on the news of Brian's departure. The timing of both exits was no coincidence, and Ackman's sell-off in particular is suspiciously well-timed. Ultimately, Pershing Square would exit Chipotle with $3 billion in profit off its $1.2 billion investment. Like Brian before him, Chipotle's latest CEO can only keep playing the same tune for shareholders, framing operational upgrades like larger rice cookers, faster grills, and prep robots as innovations that improve margins but do little to restore demand.